Hello and good evening, everybody. Welcome to this WISTA Cyprus webinar on a Friday evening with me. I'm Craig Eason. I've been invited to host the webinar for you where we're going to have a discussion with Vivian Nagel about the benefits of financial planning and securing your future financially. So we've got a few slides to run through with you, but mostly the format I'm going to take with this today is to have mostly a chat with Vivian about some of the key elements that professional women and men need to think about as they go through their career. So it's going to be a quite informal hour. There is the opportunity for you to add questions. You'll find a question button next to the screen, and you can put your questions forward and I'll be able to see them and put them over to Vivian as and when the discussion leads to them or during the question at the end. So we're going to look basically at an approach towards financial planning from 4 different perspectives as we go through from Vivian. Now, I want to introduce Vivian. She's a chartered accountant. She's done financial planning for most of her life and is very well qualified. And this slide isn't here for you to read right now. It's just to show off Vivian's capabilities briefly. But while I'm also doing that, what I also wanted to do was to make sure that you understand that this is not a webinar about offering you firm financial advice. This is a webinar sort of for fun. It's an opportunity to have a talk and chat and to discuss financial planning in the evening. Maybe some of you are at home already with your kids. Maybe some of you are still in the office. But what we're going to do is to talk about these 4 different scenarios that we want to approach. So I'm going to ask, first of all, the 4 scenarios we're going to take are a young professional at the start of their career, a more mature professional that's starting a family, a more mature professional in about the 40s and 50s year old, and then a person in towards their retirement. And Vivian is going to offer some key advice that will apply to those specific scenarios, and in some cases that will apply to all of the scenarios. So Vivian, hi, how are you? Are you well there in Cyprus?
Yeah, good evening. Yes.
One of the things, I've got the slides that you sent me here, Vivian, and I know that we're going to go into those 4 scenarios in a minute, but can you tell me from my perspective as well, because I'm terrible at financial planning. I can write a story, I can tell a story, I can do videos, I can do chats like this. This is great. But when it comes to financial planning, I look at the numbers and I get bamboozled, absolutely bamboozled. So can you tell me a little bit about why we need to look at financial planning and why is such a thing important, even though I find it so bamboozling?
It's important not for today, it's for those unknowns and sometimes known events in the future. You have to start planning now for things that may or may not happen, because if they do and you haven't planned for them, it can be very costly, very distressful. So that's why we start now, and different age groups need to look at different things or similar things but different ways.
Do you find that when you're talking to people, when you talk to professionals, do they tend to have very similar needs generally, even though they have a different approach as they go through life in general? What I'm trying to ask is, when I was a lot younger, when I was in my 20s, when I was a very junior lad, I was at sea and I just thought the world was my oyster. I didn't see financial planning as anything other than waiting until I could spend the money when I got ashore. That was my financial planning.
Absolutely.
Now I'm a lot older and I've got a family. I've got a slightly different approach, of course.
Yes, I mean, at school, the education doesn't help youngsters to understand the earlier you plan, the more secure you will be when you're older. And it's difficult for people just starting work, getting their first salaries. It's disposable income and they want to dispose of it. But statistics can show young people, the sooner they start saving, even a small amount, the impact later in life is immense, actually.
So let's have a look at the strategies that we can take moving forward then. So if I go on to this first slide, I think it's the first slide that we've got, where we look at, you know, where to begin. How do I go through that process of making a budget?
Craig, sorry, the sound went funny there. Can you repeat that, please? There's no sound, sorry, now. Hello?
Can you hear me again now?
Yes, I can, thank you.
Yep, I'm still here. Can you hear me? You can, okay.
Yeah.
Okay, now I was wondering, Vivian, about how I start that process of making a budget and where I start to prioritize.
Right, yeah, well, you have to look at the income you receive and your expenses. So you look at them, and then you should see what extra money you have to be able to then purchase these protection products or save towards an event. Also, by doing a budget, you can see where perhaps you spend unnecessarily. And if you can try and stop spending like that and allocate that money to those areas that people find unpalatable to buy these things. They think they're a waste of time, particularly when you're young, but they're not. And it's my job mostly to try and show and evidence to these youngsters or anybody of any age the importance of this. So it's finding the money. Some people have that money available, but when you're younger, you may not, or you may not want to give it up. So it's an education process.
It is, but and mixed in with that, I think, is a lot of the opportunities that don't seem to be obvious at first. And there's things like, and you've put this here, use your employer's provident fund, for example. Are there so many things that a person like me really could find if they go out there and start looking?
That's right. Well, the Provident Fund obviously is very Cyprus based. You would use a pension perhaps in the UK, other forms of investment in other countries, but it's tax efficient. Also, the employer mostly contributes to that Provident Fund. So what you put in, they may put the same in or different percentages, but that would be the place to start in Cyprus. If you have an employer who has a Provident Fund, that's the first place you should be contributing.
And how would I know whether, if I was in Cyprus, how would I know that that was available for me?
Well, I would assume that when you went for your job, that would be the Human Resources Department would tell you what the benefits are. And sometimes you may not be able to start immediately. You perhaps have to work through your probation. And you would normally get a choice of how much you contributed as well.
Yeah.
But it's tax efficient, so you know, you get allowances, you get it docked off your gross income before you start paying tax.
Different countries have got different tax regimes, of course. I'm in Sweden. It's got a slightly and a significantly different tax regime compared to Cyprus.
Yeah.
So let's start me on my career. I'm a young woman. My name's Anna. I've been to university. Parts of this is going to be true. Parts of this obviously are not going to be true. My name is Anna. I'm a 23-year-old starting up on my career. I've got loans that I took out during my university years. I'm saving up a little bit. I don't understand financial requirements.
Sorry, Craig, you've gone again. I can't hear you.
What is your stroke approach towards me as somebody? And what is the broad stroke approach towards me as a career, just leaving university?
Well, again, pay off any loans, but I say that with the exception of the UK student loan, if anyone had them, there would be no point paying that off, because there are special rules on that, that you only, I think you have to earn about 26,000 before you start paying it off, and you pay it for 30 years thereafter, very small amounts. So, but any other loans you've accumulated, there will be charged a higher rate. It's worth paying them off. And then start saving, or in this case, perhaps Anna is already saving a small amount, try and see where she can increase that. Now, again, this is quite a difficult sell to a young person when they want to go out, they want to go on holiday, they want to go out with their friends. But if you can evidence that starting early means later in life, perhaps retirement, perhaps earlier, they will have a deposit possibly for a property. When they get married, you know, they've got money for their wedding or for children. They've got an emergency fund put by. But as I say, it's quite difficult to educate people along this. Insurances, at this age, not so much. Perhaps insurance to cover loss of income.
Yeah.
It would be worthwhile, but it's a difficult sell at this age. They've got no dependents. They still don't see it as necessary.
Yeah.
But at this age, they're starting to look at mortgages and buying houses, and they need to consider these kind of things.
Tell me a little bit then about credit history. Why is credit history so important?
Well, in Cyprus, I don't think it is. But again, if you were traveling to other countries, and I use the UK because obviously I have the knowledge of that, you have a credit rating in the UK, and without one, it would be very difficult to get a mortgage there, for instance. So it is perhaps a car loan or even a credit card. And I say that again, I would be saying to Anna, take a credit card, only use it now and again, pay it off every month. But it would build up a credit history so that in future, a lender who was looking to give Anna a mortgage could have some history. Without it, it would be difficult to get a loan.
Yeah. So that's a bit like having a little bit of debt, but being able to demonstrate that you can manage that level of debt.
That's exactly what it's for. Yeah.
And is there a sort of period of time when you might suggest that would lead to a more positive credit rating? If I got a credit card, or if I got an overdraft or a loan and I looked after it for 1 year, would that be considered sufficient?
No, I would suggest about 3 years credit history. And of course, the more debt you have, the better, and the more debt you service correctly, the better credit history you have. Again, it's a fine balance in explaining that to someone, because you don't want them rushing out the door and getting 10 store cards. So it's very much a yes, get some credit to establish that pattern, but don't go crazy.
So it's about really understanding what you've got in terms of income and what you've got in terms of outgoings and how you can manage that. But how do you achieve that? There must be a balance then if you're going to have a debt which you can service, but then you've collected some income through that debt initially for whatever purposes. There must be the risk that you're going to say, look at me, I'm rich. I've got this 20,000 euro loan that the bank has just given me. What am I going to do with it? Let's go on a absolutely wonderful holiday around the Caribbean for 6 weeks.
Yeah, well, that's where you have to, the advice would be, don't get a loan for no purpose. Get a credit card with a small balance, a small credit balance, credit allowance. A car, most young people want a car. That's a perfect way to start. You get a car, maybe pay a deposit, then pay a monthly amount, providing you keep to that. Then you will build up a history. It's unlikely you can get a loan for up to £15,000 in the UK. I'm talking again now, because we're talking credit history here, where you could use it for most holiday. But they're not, it's better not to go for that route, to go for something purposely to build that credit.
And that would allow you to then build up, would that be a better chance of getting larger loans, like a mortgage, as you get older?
Yes.
Yeah. Well, that gives us a chance then to move to Christina. I'm now Christina. I'm married and I've got 2 little kids. In my circumstances, I've got 3. Buying a property.
Sorry, Craig, you've gone again. I can't hear you.
Certainly, I've got a lot of increased income. I can see that my screen has been, right. I said I can see that my screen has frozen again. So I'm buying a property. I've got a lot of outgoings. I've realised that I need to get and look at life insurance. How do I start that process then? I found a spouse. We decided to settle down. Before we know it, because life has a habit of running away with us. You know, we've got 2 little kids running around, sending them off to daycare and trying to get on with our careers, balancing everything that we can possibly balance. We have an increase in income because we're doing reasonably well professionally. So how do you start that process now? How do we start looking at what's important? Because for me, at that point, my children are the most important things.
That's correct. And therefore, your children are the most important. So you have to protect them in the event of something happening to you. And that's why you take life insurance, whole of life, term assurance, or critical illness, dread disease. These are protecting your children and your spouse from the event of something happening to you, and thus your income stopping, and they don't have it anymore. So you're purchasing.
But does that tend to be expensive? A lot of people are fearful of that. And when I myself looked at life insurance, you know, you start adding up how much you're going to pay in life insurance, not what the absolute outcome is in that worst situation. So how should I think about life insurance instead of just looking at the cost?
Well, life insurance, again, the younger you are, it doesn't go on age, but the older we get, we start getting high blood pressure, cholesterol, various other illnesses that on a day-to-day basis don't affect us, but we take medication. These things, when the insurance company knows that you have these, your premiums start going up. So again, the younger you are, because you're perceived to be healthier, then you will have less premiums earlier. How do I? Well, you insure yourself, you insure your car, you insure your buildings of your house, and we accept that because that's legally we have to insure our car. Normally, if we have a mortgage, the bank insists we have insurance on our house, so we know we have to do them. We're not choosing to do them, we have to. Again, you have to think, if anything happens to you, do you want your family to be destitute? And that's what can happen. So it's just explaining to people to make them realize that that cost is worth spending. You're hedging a risk.
And as a 35-year-old woman in this circumstance, it might be that my spouse is the one who's working, because we don't have the level of equality that I, as Christina, want to have. And I may be that my husband has to go to work and I'm left with the children. Yeah. How do I consider insurance under those circumstances? And pension, well, at that matter, I'm not earning anything.
That's right, and that's another a slightly side topic there. But even the carer, that we're talking about a housewife in this case, they should also have some life insurance. It may not have to be as much as the main earner, but it should be enough that if in those unfortunate circumstances that the carer of the children was to become incapacitated or worse, there is a cost to buy some expertise in to look after them children. You know, so it's not just earner. It's also the housewife who, although doesn't earn anything, is a very valuable commodity in that household, and you have to insure against the loss of that commodity.
Let's look at this from another perspective here, and this is one of the questions that has just come in. And by the way, everybody, you can pop your questions in. I do see them coming up on the screen, so when I can, I'll ask them to Vivian almost as soon as I can. So we've got this situation where we're looking at Christina as a married 35-year-old, or the previous one where she's 23. But what about an older woman that's starting off on a new career? The question I've got is, because a woman is 52 and not 23, what form of planning is recommended for a woman at this stage? So if a woman is, perhaps for reasons unknown, is starting down a professional career, has become independently or financially independent for the first time, and is in that position of leaving or like they are leaving university, what sort of advice would you say to a more mature woman who is starting down that career path?
Well, similar. I mean, if that mature woman had no dependents, so her income was her disposable income, and she wasn't having to protect others in the future, then it would be similar. Perhaps, well, yes, it would be similar. It would be more key for the 52-year-old to try and find more of their income to put aside, because they have less time to retirement.
So there is that the question about being able to put more money in to create that financial.
Yes, because if they were 52 and they have no children, and they're not, obviously at that age, you're not planning to have children, so you may not need life insurance.
Yeah.
You may still want to have some form of insurance in case you became ill and you lost your earnings, you know, to cover your rent or your mortgage, if you haven't got a mortgage, you know.
Yeah.
So the main thing for that would probably be retirement planning at 52.
Yeah. Let's look at this. I just wanted to just move on then to this next point here, is going back to what I was asking about recommendations for pension here. If I am Christina, I'm married, but my husband is the main breadwinner, what can I do to ensure that my pension remains secure? It might be that after a few years, I'm able to go back into the workforce and earn my own income again. But for that period, I've got no income coming in. So what provisions should I be considering when it comes to pension at this point?
Well, it depends what you've built up prior to having your family. If you've had some scheme and contributed to a scheme prior to having this break to have children, then there may be a facility within that scheme to have a holiday while you're having your career break, which you can then pick up again once you start. I'm not sure if that's how it works here, because in Cyprus, if you work and have a provident fund with one employer, you will, and then go to another employer when you go back into the workforce, then there's no carrying forward of that plan. You will just have that plan paid out, and then you will start a new one. The only thing I could advise, that when you are looking after your children, that you have an allowance from your spouse, if possible, and you make arrangements to put some of that away into a private scheme.
So you're still doing that. So let's move on then to my to something more close to me. Hopefully my screen doesn't freeze again. Right, John, a 55-year-old with grown-up and children. I'm glad you found a photograph now with a closer likeness to me. I appreciate that, Vivian. So I'm paying off the mortgage. I'm paying off the mortgage and other debts. I'm becoming a lot more financially sound, I presume. Is this probably right? So do I need then, you've suggested here that reduce life and other insurances.
Yeah. Well, if your children are grown up, they've got their own careers now, they're earning their own money. You don't have to provide for them anymore. Yes, you may have your spouse, you want them to have a certain lifestyle, but you can probably reduce the amount of life insurance. Keep some, but reduce the amount, so your premiums will go down. And again, maybe other insurances, loss of earnings. Hopefully you're getting to the point where you're coming up to retirement, you've built up a bit of a nest egg, and you have more disposable income again. So you can look at cutting costs there. You may be coming to the end of your mortgage as well. So the mortgage always requires insurance to cover the debt. So hopefully that can be finished, and that will put more money in your pocket as well, as hopefully at that age your salaries increase, bonuses, etc. And that's when you can really bolster the retirement savings, your retirement plan.
Oh, and what other aspects of this would be really useful? Because if I've got an excess pot of money, you've mentioned here review wills and other estate planning vehicles. What do you mean by estate planning vehicles? And what about being able to invest the money elsewhere?
Well, you can obviously invest, depending on what pension scheme you have. Some are very rigid, and yes, you can get them at 55. Some you can get before, some you have to wait. Tax-wise, you will need advice, because if you start taking some of these things, they could incur a tax charge. So it's best to go to an advisor, get some advice, because there are ways to do that. But with wills and other estate planning vehicles, it's really about making sure that the people you want to benefit on your death actually benefit. This is, I think I've referred to it in another slide somewhere, but this is really important, or more important, where there has been a second or subsequent marriage and children from different spouses. So there are, again, you need proper advice. I could go into it, but it's quite a big subject. But you have, in Cyprus, it's forced heirship, partial forced heirship. 75% of the estate has to go to spouse and children. Only 25% can be given to somebody else. So you need the will very clearly. If you have children from various relationships, and you're a couple now, but you have children that don't belong to both of you, there are ways, particularly trusts. Now, the word trust, a lot of people think about how much it costs to do these things, but actually you can get some quite reasonable price things, and you don't need a will, you don't need to go through probate. Everything will be passed to the people you want it to go to in the percentages you want it to go to. So that is what I talk about when I talk about estate planning vehicles.
And is it a case then that I'm able to be a little bit more creative with my money as well?
When creative, I wouldn't suggest you're more high risk with it, because you're only 5-10 years away from retirement, so you wouldn't want to be too creative if that's what you meant. Some people want to start a business at this age because they've built up some money and they want to have a go before their working life is finished. That is creative, I guess. But from an investment perspective, at this age, you've got to consider that you may want that money within the next 10 years. So you have to be very balanced in where you invest the money. So, of course, some shares, some bonds, some cash, property, a mixture, not too aggressive.
Okay, let's move on then to much closer to retirement. So I'm now back to being Emily, or back to being a woman. I'm 67 years old. I'm in retirement. And you've mentioned here now tax planning is key to ensuring income is optimal. Now, this obviously implies that I'm living off of the money that I've invested. I'm living off of the pension. I'm living off of my investments. So what are we talking about here when we're talking about this level of income that gives me the lifestyle that I want as a 67-year-old retired, I'm presuming professional woman who's had a career as retired from that position? What are these thoughts then that are going through, that need to go through my mind as I'm in retirement?
Well, you need to consider how much tax you are paying on that income. For instance, and my first thing on here is bank interest, fixed bond income, and dividends from shares are not taxed under income tax rules. They're taxed under defence levy here. And dividend income is 17%, bank interest is 30%. So you can, probably prior to retirement, really, your advisor you could wrap those investments up so that none of that is taxed. There are ways to do that.
So how do you do that? How would I go about achieving that?
Well, you put it in basically an insurance product. Now you have to be careful of charges, because the charges could then actually be more than the tax you're saving, but you can do it, and all of that income will still be paid, but it's not classed as income anymore. It's classed as an insurance payment, which is not taxable.
Yeah.
There are other things, of course. Capital gains tax in Cyprus is only on immovable property and a couple of other things. So you could look at taking capital gains from investments rather than taking income, because then that wouldn't be taxable event either. Also, there are two tax bands that you could opt for in Cyprus. One is the pension tax band, which is 5% of income. I think you get an allowance of about €3,400, and then you start paying 5% on any other pension income. Or you can have it as the normal tax band, so 19,500 is free, the next so much is at 20%, etc. And it depends really on how much pension you have. If you're getting €200,000 pension a year, it's probably better to go for the 5% as it is to go for the normal rate. But if it's a smaller amount, then you've got to look at it. And again, an advisor or a tax specialist will help with that.
You mentioned here this end of life preparation as well. I know that sounds quite depressing and quite dire for a Friday evening, as we're probably all looking at our glasses of wine. But it's a level of maturity here in recognizing that you want to pass something on to the rest of the family. Yeah.
I mean, you know, we should be thinking about this all our lives, but it isn't a nice subject. You have to think about where your assets are, document them in a simple way so that any members of the family can find them in the event of anything happening to you, and can access them, can write to these people and tell them what's happening. So it's really, it's very important, and people don't think about it because they don't want to. And then the people left behind at a time when it's not very pleasant are forced to search high and low, and possibly they might miss out on some investment that's sat somewhere that they have no knowledge of, and they could be benefiting from that.
Yes.
And then, of course, you can, even in Cyprus, prepay for your funeral, plan it. It's worth doing, I think. I mean, in Cyprus, of course, it's burials if you're Orthodox. For someone like myself and other expats, there isn't the option of cremation here, but you can organise that from here, but it's best to pay. and you can pay for it, and then your family don't have to worry about it.
But you also mentioned here on the slides, going back to you referenced trusts shortly a little while ago. Placing your house. I've never heard about placing your house in a trust.
Right, well, you can place your house in trust in most countries, but in Cyprus, again, for a very reasonable, I think a very reasonable cost, you can place it into trust. Now, I've mentioned that, well, not here, but it does save some fees, but the most important part of this is a trust is a legal entity and it doesn't die. So if the trust owns the property, it doesn't mean you don't live in it. You can tell the trustees to sell it and buy a different property, but it doesn't die. So if you die, your children can say to the trustees, sell that property. They're possibly living abroad, haven't got the time or the inclination to come to Cyprus, and you can do that. And I think it's about €2,000 to set up and about €250 a year. It really is, in my opinion, a fabulous estate planning tool.
So it's a way to utilise the money to create an asset that can be handed over to your.
Yeah, well, the asset can be handed over, of course, through the will and through forced heirship rules, but you have to go through probate, which can take months, if not years, depending on the complexity of the estate. There could be a lot more property or a lot more assets. And it's only for property, the figures I've just mentioned. But I really can't enthuse about it enough. I just think it just gets the beneficiaries access to the house, being able to sell it, being able to do what they like without going through a very long, laborious system of probate. And again, when we talk about the couples that have offspring, children from various relationships, the trust is the way to go. Now, if you've got other assets or large assets that are not property, you'd have to look at other trusts, which are a bit more expensive, I have to say. But for most people, the property is their largest asset, or properties. And this is just in Cyprus, I'm talking, for these figures. You can do international trusts that will encompass foreign property, but for the prices I've just quoted, it's invaluable. And it really gets rid of the headaches when you have 3 children from one partner, 2 children from that partner, and 1 child from them both together. It's a massive headache to cover that in a will.
But it's easier to manage that within the scope of a trust. We've got about 15 minutes left. So if anybody's got any questions, I'd appreciate it if you could just start popping them into the question box now, where I can see some of the other ones that are coming in. I just wanted to just go on to this slide before I just go into some of those questions, which involve me going back in the slides as well to some of those scenarios that we were showing. Tell me about some of these steps then in the uncertain times, how we plan for uncertainty. How do we plan so that we can have a certain confidence that we're doing the right thing, but give ourselves the opportunity to grow regardless?
Well, and this slide in particular was really, I think it was about COVID, and people are uncertain about their job security at the moment. So if you are, of course, you're not wanting to dig deeper into your pocket now and buy these insurances and put more away for retirement because you're not sure how secure your employment is in the near term. So really, this is more about, again, with all financial planning, looking at your budget is key. Unless you have a big income where a budget's not necessary, then you still have to pay out quite handsomely to advisors to help you be tax efficient. But for the general populace, then looking at your budget, if you're uncertain about your employment, if you have insurance, which a lot will already have, speak to the insurance company, because some policies of all types, this could be house insurance, life insurance, or most insurances have the ability for you to have a holiday, a payment holiday. Now, I think I mentioned sometimes that you tick that box at the beginning when you take out insurance. It's kind of an added benefit, and you may pay, you know, 50p a week more for that benefit, but it's worth asking. And similarly, if you have a regular savings product, pension, provident fund, ask the question to the trustees, because again, you should be able to get a holiday. And that would mean, obviously, for that time, you know, you're not adding to it, so you have to take that into account. But you shouldn't have to pay it back in most cases, but you may have the ability to do so for the savings schemes where you need to put it back in. And provident funds, not pensions, but provident funds in Cyprus, they do have a clause where you can have a loan in certain circumstances. But I have made a caveat there that look at all your spending first. Do not use that as the first step to sorting your problems, because it will be more difficult to make that up for your retirement. So really, that was more to do with the general feeling now in these uncertain times. The other uncertainties in life we've covered by taking insurance to hedge against the risks.
Good. Let me go to some of the questions. I've got one here. Is there a recommended strategy on how much, what sort of percentage is reasonable for a 30-year-old person to save as investment money for future investments? If you're giving broad, I know this isn't a webinar where we're giving specific advice to individuals, but are there kind of ballpark figures when we look at our planning that we say, okay, that amount of money?
There are, I haven't got them to hand, but there are. At 30, you're probably looking at 15% of your income, maybe more actually, but 15% I would say. I haven't got them figures in front of me. I'm just picking them out of the air, but they're quite high.
Yeah. And another question here is, it's related to what you were talking about, properties in Cyprus. Could you please go through the benefits of a small business investing in the property in Cyprus and abroad, and which difficulties that may arise tax-wise? So when we're looking at investing as a small business, we can create a small business, investing in property in Cyprus and abroad. What sort of pitfalls may be around that we should be aware of?
Well,
again, caveating that this is not proper financial advice you're giving.
Well, I can't speak on the tax side of a small business. I'm not a tax advisor, so I can't speak generally on tax and what benefits there would be to buy property as a small business. But for anybody buying property, are you buying, if it's for investment purposes, is it going to be a building, or are you looking for a property fund to invest? Are you looking to benefit from growth of property in general, or are you looking to buy a property and rent it out and get rental income? A fund where you're investing in lots of properties, you're just buying units in a collective investment scheme, that has the benefit of liquidity. So if you put your money in and you need your money out, you can get it. If you buy a property, a bricks and mortar in Cyprus, the liquidity is the issue. Can you sell it quickly if you need the money? Okay. Without more detail to that person, perhaps they want to email me, but I can't really give more specific because I'm not quite sure what they want to invest in.
So, well, maybe I'll put up the contact details at the end of the webinar so that people can get in touch with you if they want to and need to. Another question here, it touches on the tax issue again. Is there a cheap cheap, tax-wise, high-yield investment strategy available in Cyprus, like the idea mentioned with trusts, what the general public would not be aware of?
Well, there's no high yield investment that I would recommend right now, because we're living in a very low interest rate environment, and high yielding investments come with very high risk and sometimes default. So there are, again, I think I touched on this with Emily, the 67-year-old. If you have a lump sum to invest, there are what I call, you can wrap them within an insurance product. Now, I wouldn't use a Cyprus insurance product. I would use an Irish one, but there's reasons. There's more flexibility. You can get better investments. You can choose your own investment, and they are tax efficient, provided that you look at the charges. With everything in this, when it comes to insurance, there are commissions that are paid. So you have to make sure that you're not paying all these commissions. You'll have to pay a fee, definitely, to the advisor. I charge a fee. Everybody has to make money, but
Yeah.
So you have to make sure that the cost of the product is not outweighing any tax benefit. But within that, again, we go back to high yield, and if this year you could make 50% in some investments, but you could have lost some, because we've had a roller coaster this year. There's funds, I have a fund 250% in the last 5 years, but I would never suggest someone put all of their money in it. So it would only be a small amount of your portfolio would go into something like that. So you really, high yield, the word is suggest you're going to get 10% a year, and you may well get 10% one year, you may lose 10% the year after.
Yeah.
So,
should I read high yield from that perspective, Vivian? Should I read high yield, particularly when I'm looking at bonds and funds? Should I look at them as potentially being high risk because of that risk of the roller coaster?
Yes, because you start with interest rates, and interest rates are negative in many countries now. So any bank that's paying any interest is desperate for your money. And it goes like 0.5%. Okay, they're not that desperate for your interest. 1%, 3%. Why are they paying me 3%? They're not getting it in the money market. And it goes on. This follows through in bond markets, very expensive at the moment, very low yields anyway. And then you get to shares. And the majority of investors now are taking bigger risks, because there's nowhere else to get growth on your money, so they're putting them into shares. The yield on shares has fallen as well. And the UK now, hardly any UK stocks are paying a decent dividend. Some globally, but so there is risk, but it's there. If you're aware of it and you accept it, then of course you can take the risk.
How would you suggest that, whether I'm any of these 4 scenarios that we've used during the course of this webinar, what would be the best way for me to improve my financial literacy, to improve my knowledge and awareness? Because if I've got knowledge and awareness, then I've got better skills, and I've got better tools to make better decisions. Well, so how can I go through that without going and getting a university degree in financial management?
Well, you can read. I mean, we have the internet now. You can read so much on everything, can't you? But if you don't, you go to a financial advisor and discuss it with them, and then you make your decision whether you want to employ them as your advisor or not. Some people do make their own decisions. And investment-wise, the internet, with all the stockbroking accounts that are £10, £5 for a trade, people have thought, this is great, why am I going to pay an advisor? So they go and do it. And for maybe 10% of those people, they actually make money. They're not greedy, they take profit, or a small profit, and they're very disciplined. But for the rest, they either make poor choices or they make good choices, but they stick with it. And it's worth paying for advice mostly, but you know, you educate yourself by all means. Certainly on the insurances, you would still have to go and probably pay commission to someone in insurance, because most insurance brokers, you go. But still, to be aware of the choices. I think the internet.
I'm going to ask another question. We've got about 3 or 4 minutes left if anybody else wants to have the last question here. But just one more question that's come in. You've mentioned that bond income is subject to SCD tax. What's the percentage of SCD on coupon interest on government and corporate bonds purchased from abroad? And that seems like a very specific question, so they may want to get in touch with you after the webinar for more detailed, but it's about the percentages on coupon interest for government and corporate bonds that are bought from overseas.
Yeah, that's a good question. It's 3% on local. Well, it's going to be 17 or 30. And I
17 or 30.
If that person wants to get in touch, I will definitely get the answer for them.
Well, I'll just as we run up, there's no other questions at the moment, but
Craig, there was one that came in earlier that I can answer. One came in this morning. Someone asked whether there is an insurance that you can lay over the top of GESI. And GESI is the National Health Service here. It's just been going for a year or so. There isn't one related to GESI, but the normal insurance companies here that have the medical insurance, they have the basic cover, which will cover for inpatients or abroad, major things. So you could opt to take that, or also what they do, you could have the top version or the middle version or the basic. Like for instance, my insurance, I have a 85 euro excess, so I pay 85 euros a year, and then the rest they pay. But you could have 1,000 euros a year excess. You know, you could bring your premiums down to offset how much we're paying now for the GESI system. So there are options there. They need to speak to their insurance agent.
So there's certainly an element of flexibility. Vivian, just on an end note here in terms of investments on this slide, I don't want to go through the actual detail of this slide because people can read it at their leisure, because this webinar is being recorded and people will be able to go onto the WISTA Cyprus website and watch this recording if they wish, and certainly get in touch with you as well. But you've got this note here of having all your eggs in one basket, which is disastrous for wealth. Now, I can understand that putting all your eggs in one basket is an old saying, but when it comes back to that discussion we were having about bonds and funds, about spreading across, so you might have a bond or a fund that has got that 230% yield on it that you mentioned, but the next day being high risk, it could go down. So being able to spread it so that your overall portfolio remains relatively low risk and therefore a balanced kind of growth.
That's right, it would be balanced. So you would have maybe, say you have 10% in the fund I'm talking about. It's not particularly high risk, but it's all in equities. So it's just done well, but it can fall 50% as well as go up 50%. So you'd have 10% of your money in that. You'd have 10%, that's a global fund, that one. You'd have 10% possibly in a UK fund, 10% in a German or broad European fund, 10% of maybe 5% in China, 5% in India, 10% in property. And maybe 10% maybe in global bonds, maybe. But that's what you do. And then and gold, at the moment, gold. You should have a little bit of gold in your portfolio. It doesn't produce an income. And for some years now, it's done nothing. And people say, oh, why have I got gold? But the minute stock markets fall and there is worry about economies, gold goes up. And so it's a good balance to have.
Well, again, I haven't got time to go into the death of you or your partner. We touched on it a little bit during the course when we were looking at the scenarios. So I'm not going to tell them, but again, these bullet points are here for other people to look at if they wish in terms of their actual planning. So that ends my slideshow. Yep.
Craig, can I just, Uta did mention that somebody was interested in me touching on divorce. What I would say to them is email me. It's a wide subject, and it's not really financial planning as such. It's more how to prepare for these things or how to look at your finances. So I can deal with that individually if that person wants to email me.
Okay, good. Well, Vivian, it's been great having a chat with you over this last hour. Apart from my ability to become 4 completely different people over the course of an hour, I've learned a great deal about financial planning and financial awareness, and hopefully other people have as well. So on behalf of WISTA Cyprus, thank you very much, Vivian, for your thoughts and your inputs. If anybody wants to get in touch with her, you will find her details on that first slide, which you can find during the recording. So I'm going to sign off now and say thank you to everybody who's here, and have a good Friday evening and a pleasant weekend. Thank you.
Good night.
Good night.